George of the jungle, strong as he can be.
Okay, folks, it's tax time again, and if you have self-employment income of any sort, or if you itemize your deductions, you're not going to want to miss this. There are some tax prep killers that we're going to prevent you from making these mistakes in the creditjungle.com. This is George Anderson. Thanks for joining today. And if you're one of my past clients, you got a phone call from my son, or at least he left a message for you, because I've been calling everybody before they file their tax returns, because there are some significant changes going on in the market with respect to IRS guidelines and underwriting guidelines. And unfortunately, if you don't understand how these things interplay with each other, you could inadvertently shoot yourself in the foot if you intend to purchase a home or even refinance your house. So let's talk about just a couple of real common mistakes that I see happening on people with their tax returns. And the first one here, you're going to be scratching your head going, well, why would I do that, George? The first one is what you want to declare for income, okay? You need to understand that if you have a CPA and if he's doing his job, 20 some odd years ago there was a CPA firm that ran an advertisement that I just loved it. It says, when you care enough to send the very least, okay? So if a CPA is doing his job, and if you really like him, his job is to do what? I mean, it's to reduce your income and find as many expenses as he can so that you can reduce your taxes, okay? So when it comes to your income, I mean, it's great. Okay, so maybe you grossed $100,000 in whatever your business was, but if you had $70,000 worth of expenses and you filed your tax return telling the IRS that you made $30,000 last year, and you're all excited because you're going to be able to get the tax credits and with the kids and all the other stuff, and you're going to end up getting more money back from the IRS than what you paid in. That's wonderful, okay? But when you go and apply for a mortgage loan, and if that's the only income for your household, let me just help you out a little bit. Okay, pardon my slang English here, but you ain't getting nothing on a $30,000 a year income unless you have got like $300,000 to put down on a $400,000 home. So if you're not in that thing, one of the things to consider is, well, what can I do if I want to show more income? Well, okay, so if you want to hang on to your $70,000 of expenses, let me ask you a question. Could you tell the IRS that you actually made $150, that you grossed $150 instead of $100? I mean, isn't that stretching? I mean, why would anybody do that? Well, do you think the IRS cares? I mean, if you actually showed that you made $150,000 and you take your $70,000 of expenses, if you want to pay taxes on the $80,000 and you write a check and you send it in, trust me, okay, they're not going to have a problem with that. And the converse of that is true with your expenses, okay? Now, you can reduce your expenses if you want. You can keep the income at $100,000 and maybe only take $20,000. But if we're trying to document $80,000 worth of income, what does the lender care? What do we really care about? What we care about is that you actually file that tax return and that you actually pay the taxes that are due on it. Okay? How you come up with that number doesn't really matter. And in fact, everybody that thinks that wealthy people should pay more taxes, well, they don't have to. I mean, they can voluntarily do it, right? I mean, if you wanted to, if you owed $10,000 in taxes, could you write them a check for $15,000 and just tell them keep the change? Yeah, you could. Okay, they would take the money. Okay. So just understand that what you're trying to accomplish with an underwriter may be at odds with what you're trying to accomplish with your CPA. So point number one. Point number two is your meals and entertainment deduction. Okay, this is a little bit different on here. So if somebody had, let's just say that they're going to write off $10,000. Let's make it easy. Let's just say if they're going to write off $5,000 of meals and entertainment expenses, taking clients out, golfing, restaurants, whatever you want. Okay, if your tax return shows that you have written off $5,000 worth of meals and entertainment, what was your actual expense? Okay, your actual expense was $10,000 because the IRS only lets you write off 50% of your actual costs, okay? So what does an underwriter do? An underwriter looks at this and they go, oh, well, wait a minute, they wrote off $5,000. Well, that means that their real expenses were 10. So now we're actually, one of the categories on your tax return the expense that you took on your taxes is actually going to be doubled. Okay, so if your net income was, $80,000, but $5,000 of that expense was meals and entertainment, well, we're actually going to take it to $10,000 when the underwriter finishes with it, and so your taxable income or your effective income isn't $80,000 anymore. Now it's $75,000 because this is the way that the IRS looks at it, and so underwriting says no, they actually spent more than $5,000. They actually spent $10,000. They're only getting to write off $5,000. Category number 3, vehicle expenses. Okay, now for people who are driving, if you have to have the $120,000 Ford F-150 or F-350, chances are your actual expenses are going to be astronomical in the way that you calculate your insurance and your vehicle expense and everything else. But let's just take somebody who just has an average car, and I don't know what average is going to be, but if their actual expenses were, say, $15,000, okay, and they've documented that and they've got the receipts and everything else, and let's just say that they drove 20,000 business miles, okay? The IRS, this is kind of an interesting little thing here, and a lot of people don't realize this, but I actually did a loan a couple of years ago for an independent truck driver. And he didn't have like a big semi-rig, but he had, it was kind of like a transport type thing, and I can't remember what size truck, but it wasn't an 18-wheeler. But he had driven over 100,000 miles. And his actual expenses that he took on his tax return, then it was uncanny. The numbers, based on had he took his mileage deduction versus actual expenses, it was within like $1,000. And so we went actually back to his CPA, and we had his CPA refile and recategorize the way that he took his expenses, and we were able to get this worked. It's not always going to work out this way, but if he had 20,000 miles and his actual expenses are 15 grand, well, now that's a $15,000 hit from his income. Okay, if we're looking to get $80,000 of effective income, that expense, if he took it that way, would actually drop his income down to $65,000, and it might not make it work with the debt ratios. But what if he decided to take a mileage expense? Okay, the mileage expense over here, 20,000 miles times 57.5 is going to be 11,500. Okay, he's not going to write off as much. He's going to lose $3,500 worth of his write-off that he could have gotten. And you're going, well, yeah, but why would I do that? Because I'm still writing it off. Is $3,500 going to be that much of a difference on my income? Well, it might, but for the year 2020, of that 57.5 cents per mile that the IRS allows you to write off if you're tracking your mileage, 27 cents of that was depreciation. So what do you do with depreciation? Well, depreciation gets added back. So 20,000 times 27 is $5,400. Okay, so we're going to add back $5,400 to this, and so what is that? $6,100. So his actual income is only being reduced here. He's actually only reduced his income here by $6,100, but he's getting the benefit of an $11,500 write-off. Okay, so again, this income here is just considered that, if the vehicle was worth X at the beginning of the year, after you drive it for 20,000 miles, it's going to be worth X minus 27 cents per mile. Did that money come out of his pocket? No, we're just saying that the value of the car depreciated, and the IRS allows you to take a depreciation charge like that. Now, there's other assets and other categories of assets in a tax return that you can take as depreciation charges, and those get added back to income. So if you're in that business where you have, I've seen people that have had 20, 50, over 6 figures worth of depreciation charges based on what type of business they're in. But that's always something that can be added back in there. There's a couple of little squirrely exceptions on Section 179. But this is just something to consider. Look at how it works both ways. But this right here is effectively giving my borrower another $450 a month of income, but he's getting the benefit of writing off basically $1,000 a month in expenses, but almost half of that comes back. So just a couple of tricks for the trade. Tax time's coming up. I don't think anybody can file until about middle of February this year because the IRS is busy with PPP loans and all this other stuff that's going on here. So this is, again, it's one of those time-sensitive videos, so I'll make sure and get it up right away. But hopefully this helps you. So if you're planning on refinancing, if you're planning on purchasing a home, for most people, this tax return is going to be, you're stuck with it for 2 years. You're stuck with it for at least 1 year. So get it right before you file. I'm asking my clients, look, go ahead and get your tax return to a final draft. Then let me take a look at it. And then let's figure out what your goals are, and let's see if this tax return is going to allow you to meet whatever goals you might have for the coming year. Very simple, very easy to do, but you can't do it after you file. Thanks for coming in to thecreditjungle.com today. This is George Anderson. I look forward to talking with you and helping you with your unique situation. Have a great day.